Hello and welcome everyone to today's session. My name is Mohammed Shanti and I am a market analyst at FX Pesa and EGM Group. And today scan the markets with Mohammed Shanti in order to understand what's going on in this market and how to tackle the latest developments, especially from the Russian-Ukrainian war. Also, the latest Bank of England and the FOMC rate hikes and what happened and how can we benefit from it in the long term, short term. And at the end of the session, we will talk about the trading strategies that I provided on Tuesday and how we can take a trade based on that. But just a reminder, FX Pesa basically and all their analysts basically provide only kind of information and insightful information for you to help you with trading, to make it easier for you to take your decision. All of these information that we provide are for your benefit in order to learn from the best, also to learn how to make your trades, and also to execute better strategies and so on. But please be aware, anything we provide here from terms of numbers, it's basically not a recommendation, but rather information. So since we got this clear, let's talk about what happened during yesterday and also in today's session. So yesterday we had the Federal Reserve pushing interest rates higher, and we can say officially it kicked off its tightening cycle yesterday, raising interest rates by a quarter point, although the rate hike itself was fully priced in the markets. And as you can see, the central bank still delivered a hawkish kind of twist by signaling another 6 rate increases for this year through its dot plot projections. This was exactly in line with the market pricing heading into the event, but exceeded even the wildest expectations among a lot of traders. Okay, a lot of traders expected a slower approach for the let's say tightening cycle, but basically the dot plot showed us 6 rate hikes coming, and this is one of the things that actually affected the market. Nonetheless, the takeaway we can take from the Federal rate from the FOMC is that the Fed is serious about fighting inflation. There's a sense that they waited a bit too long to get the normalization, and basically the latest commodity shock added fuel to this urgency. So what happened is that we had inflation as the main theme at the start of this year. Now we are witnessing the war between Russia and Ukraine. This has actually been fueling up what the Fed was planning to do. So basically, they want to fight inflation, and they said that inflation will peak at a higher rate and take even longer to do so. So basically, for them to push to actually expect that there is 6 rate hikes this year alone has helped traders to understand what's going on in the market. Another thing that a lot of things that maybe it's not understandable by a lot of traders is that whenever interest rates goes higher, how can gold go up? How can commodities in general go up? How can the stocks goes up? Now, the thing is, it all depends on the US dollar. So the US dollar traded lower against a basket of major currencies for the third session, daily sessions, and basically acknowledged the Fed acknowledged that the Ukrainian geopolitical risks kind of slashed its growth projections by almost half, almost to 2.8%. But the thing is that the head of, or sorry, the chairman of the Federal Reserve actually commented and gave some bullish views, or basically some reaffirmation to that the economy is growing, and helped traders to focus that there is the economy is strong. We have a strong labor. I know we have inflation high, but we will tackle it as much as possible. And these kind of notes kind of helped traders to push the sentiment higher for indices. Now, we can see that on the Dow Jones. From a technical perspective, you can see the Dow Jones in the 4-hour chart is trading near a long-term resistance level, which is the 34,144 mark. It is just above that, which could indicate that the prices might test next, which is at this level. We can show you this level is 34,500, almost 34,500. At the feet of this level confirms that the bearish downtrend that happened from before is officially over. So we could see that the dip has ended, and now we can enter the market higher and higher and aim for higher levels. The next level would be after this. It's a clear resistance of 35,164 mark, and the next to the levels of 35,820. So expect a movement, a higher movement from these levels, almost 1,200 points. So please be aware that this technical setup is very crucial. Another thing you can look at is the stochastic and also the MACD. The MACD gave us a bullish crossover here, okay, and the continuation is happening, so it confirms that the bulls are in control. Also, the stochastic is saying basically there is a lot of crossover inside the overbought territory, which could indicate that there is some fighting happening at these levels. And now we're waiting for more confirmation. We're waiting for the 4-hour candle to confirm that it closes above this level, and the next we are waiting for the bulls to push prices even higher. Now, from the downside, prices must go all the way to this level to confirm that we are basically in a range trading. So if you look at it, every time it reaches this resistance, it goes down and up and down. So please be aware of that. Closing above this is a full breakthrough, and then we might see a test of this area. A failure to defeat this area, we could see prices go down. However, we need prices to go from the downside here to 33,330 to confirm what's going on. Another central bank actually affected the markets today was the Bank of England. The Bank of England pushed prices a little bit down after their latest small dovish, I don't want to say dovish, very dovish, but rather cautious tune to their latest economic projections and also to their latest interest rate decisions. So the Bank of England actually surprised the traders and toned down its rates hike communication during today's policy gathering, knocking down the pound from a weekly high of 1.32 to almost to 1.31. So why did this happen? Now, the Bank of England has its own members to vote on interest rate, and out of the 9 members, one of these members decided to vote for holding the interest rates as they are. However, the rest of the 8 members said that they actually voted for pushing interest rates higher. Now that left almost a cautious mood to traders that maybe the Bank of England is not fully committed to its tightening cycle, and maybe they're gonna slow down now, and that sent a message for the bears to push prices down, and this is what happened. So if you look at from a technical perspective, you can see the pound was able to bounce back, okay, during the 4-hour chart, and stopped during this after the Bank of England press conference, and after their economic projections. Now they're expecting the inflation to go as high as 8%, which is one of the highest numbers in recent years. So this is a really bad thing for the pound, and this is why we're seeing a slowdown. Now it's normal to see a pullback again after that huge candle in the 4-hour charts, but it is a signal for us as traders that maybe this uptrend is only just a reversal, a small reversal for this bearish downtrend. You know, even though the downtrend here officially finished around this area, but still we could see a double top formation, and then we could see prices go down. So please be aware that this particular pair, we might see a bearish downtrend happening soon, unless we see a breach to a really important level, which is this level, which is 1.32 36, and the moving average will be the next moving average, the smooth moving average, 1.3402. As long as prices are below these two levels, the bears remain in control. Now we are seeing the MACD is trying to go higher and higher, confirming that this was a bullish setup happening. However, the stochastic is giving us another signal. Went overbought and now it's out, which indicate there is a reversal happening to the downside. So mixed performance. Therefore, we're waiting for more confirmation on the pound. Another pair we need to look at is the yen. The yen pair has been moving in a rally lately, especially because of the strong US dollar in general, and also because of the yen weakening down because of their because of the divergence between the bond yields for the yen and for the US dollar. So the Bank of Japan will announce its next policy decision early on Friday at not decided time, but as usual, the meeting will be probably I don't want to say uneventful, but rather we need to hear from the governor of Garuda saying about there's no adjustment will take place. Expectation that a lot of traders are expecting no change in their policy, staying like trying to fight inflation to keep inflation at 2% and to do it in a sustainable way. However, this could actually give us a really good setup for the yen technically. Why? Because there is a bullish setup. Now, whenever trends happening, you need to give a space for trends to continue. So what do I mean by that? Prices could go up and then down, up and down. So it moves in a waves. That's why we need to be careful here. Now, whenever we take a trade from this area, we need to wait for a small dip to happen as long as it doesn't go below the main level of 117.68. Okay, if prices went down, it doesn't mean that I should enter now. It means that I need to wait for the dynamic support and resistance. So the dynamic support here is the moving averages. The first one is here, the second one is here, and also there's a huge previously resistance level. It became a support now. So we have 4 main levels from the downside to see this end rally to happen. As long as prices are not going as low as this level, the continuation could be seen, especially if the MACD gave us a bullish crossover to the top side. Now, once it happens, we could see prices go higher. Now, the main reason why this dip is happening, or why this small retracement happening, is that, as I mentioned at the first of the session, the dollar is trading lower against a basket of major currencies because of the Fed. So and you can see the yields on the 10-year maturity date bonds, basically US 10-year bonds, are basically going lower, and this is pushing the US dollar lower. However, the yen is still weak. That's why we're not seeing a huge drop to the downside. This can be seen in the euro, for instance. The euro is a different story. We are seeing the euro is continuing its bullish setup. Now, we said in the last session, we said that it's very important that prices remain above the 1.0898. So if prices continue to stay above this trend line, the bullish setup continues. And that was confirmed by this candle in particular. Especially this candle defeated the latest highs and the moving average. And also we are seeing the MACD going into the positive territory. All of that confirming that the bulls are in deep control. What's next for buyers? The next level would be the smooth moving average, which is 1.1241. Now, this is a really crucial area to think of, because traders usually wait for the overbought, or the, let's say, the stochastic from overbought to wait for a sell. I would rather wait for prices to dip and trade from these area with a stop loss around here. Why? Because I believe the trend line could continue, and we could see small dips and it create higher lows compared to these lows. So it's really important to think that prices go up, down, up, down, up, down, and then that's the main target. If prices went below this trend line, we need prices to defeat this level first. Why? Because we could see prices range. So this level is a pivotal for us to know if prices would range in the future or not. If it was defeated, sellers would aim here for the 0.807. But the latest fundamental news actually pushing the dollar down. The euro is taking benefit of that. Plus, the latest peace talks between Russia and Ukraine actually lifted a little bit the euro in general, and that's why we're seeing the euro going higher and higher. So my main level to aim as a bullish trader would be the 1.1240. From the downside, I would wait for prices to breach this level and then wait. I would take a trade from here and then aim for that level. So please be aware of that. So going for the commodities, going back to the commodities, gold has been one of the latest stocks. A lot of traders are focusing on gold lately, and one of the things that a lot of traders love to trade is gold. Now, gold has been affected heavily by the latest movement of the US dollar in general, and also because of the peace talks literally affected the commodities down. If you look at oil, and even if you look at gold, both of them went down, and also because of the strong dollar. Now, the moment the dollar got weaker, we're seeing prices are going higher. Now, we've mentioned at the start of the session, we said that the Fed, as expected, pushed interest rate higher. Okay, and I said again that the market already priced in that movement, and this is what happened. This pricing in already happened. So what's going to happen after what already been priced in? If you compare from 2008 until 2015, there were almost 10 interest rate hikes. Okay, each time historically, if you look at the gold data in general, if you look at the daily gold prices, you could see each time there was a rate hike happening, markets already priced in gold to go down. And what happened exactly after the event, we saw 7 out of the 10 rate hikes, 7 of them or 8 of them, gold went up. So history is repeating itself, and this is why we're seeing gold going higher. Now, would this a really good area to buy from and aim higher? No, but rather I would rather wait. Why is that? Because there is a huge dynamic level ahead of traders. One of them is 1949 or 1950. Another one is this high over here. So the high over here, almost here, this area, which is almost 1952, 1950. So this area is very crucial. So we could see a formation of what exactly? We're seeing maybe head and shoulders, okay? Head and shoulders setup. So maybe prices would go down and there would be a neckline awaits traders, which is the 1900. Now, exactly the moment the FOMC rate decision happened, we saw prices wick from the top side and from the downside. We saw prices go all the way from 1902 to 1916 and then went down to almost 1893. Okay, but it went back again after the press conference from Jerome Powell. Now, what do we expect more from gold? Now, gold could be trading within a narrow range in the couple 3 daily sessions. Why is that? Because first of all, there is a small minor pullback from treasury yields, small minor pullback from dollar, and also inflation expectations for the Bank of England is 8%. The Fed said inflation is going higher. So inflation, whenever inflation goes up, gold tends to go up. Also, whenever interest rates goes up, gold tends to go down. But that's why we are saying mixed performance could be ahead of us. However, what do we do now? Whenever we know there is a chance, there is a range bounding market happening, we use the stochastic or the RSI for overbought and oversold situations. So now we are in overbought territory for gold. So prices, the 2 lines basically are giving us almost a crossover to the downside. Now I would rather wait for prices to go down. So aim from maybe this area, 1930, and aim to the 1900. Get out in the 1900 and wait for confirmation. Now, prices, if we're able to defeat these 2 levels, which is 1950 the trend could continue. If we saw a pullback, I would aim for the 1900. Again, I would wait here also. If prices were able to defeat this area, I would pull back. I would actually take a trade to the downside more. Now, if prices defeated this level, that's a confirmation that there is a new downtrend happening compared to this uptrend. All right. What's the main level for sellers would be? Next, 1871. So from 1890, I could aim $20 to the downside, to the dynamic support over here. Okay. From the top side, what's my next level if this level were defeated? Probably the 1990, and the next the 2000 and 2008. So these levels are very, very crucial now again. But the gap is the difference is there is clear indication we might see a huge movement in gold, $50 or $40, depending on what's going to happen in the coming sessions, in the 4-hour sessions, and so on. Another thing that you guys need to look at is so I have this question that from the last session, that a lot of moving averages, I'm using a lot of moving averages. So the moving averages that I'm using is one, very simple, moving average smooth 200. Then another one is 100 moving average smooth, simple. Another one is 50 moving average exponential. So I have exponential, simple, and smooth, all three of them. So I use these averages in order to understand what's going on in the long-term view. Okay. Now, depending on my strategy as a trader, I really enter this market. So let's say I'm trading very short. So let me remove these comments so you can guys see. So if I'm trading or scalper, I would use it differently. So these numbers that I have already in mind. Okay, so what to do next? So if you look at the 15-minute chart, I wouldn't trade based on a breakthrough for the smooth, but rather I would always wait for a closing above the moving averages itself. So for instance, you can see the downtrend happening the moment prices went below the moving averages. So I would actually take a trend down. The moment it went above it, that's my exit. The moment it goes again, I would go down. Now, since I know there's a chance for gold to go in a range trading, I wouldn't look at these. I would rather wait for my exponential to be my main entry indicator. How do I do that? I just wait for prices to close above it to enter a bullish signal, or to enter a bullish trade, or wait for the prices to close below it. The moment it closes below it, I take a selling signal. I take that as a trade for me for the downside. Very simple. Now I use the stochastic not as an entry here, but rather as an exit. So for instance, the moment it closed above, so if we remove these simple moving averages, so I'm gonna move them. I'm gonna leave only the exponential one. Okay. Now, this might be much clearer now. So what happened is that the moment it closed below, I need to look for a bearish setup from the MACD. Okay. The moment it closed above it, I need to look for a bullish setup from the MACD. So at this candle exactly, right, there was a bullish setup. I took a trade from here. Now, previously, it happened before. It gave me a small win. Almost $7 or $8. Now I'm looking for the big win. Look here, the moment it gave me a crossover to the top side, that was my main entry, and my goal is happening. So it never crossed below the exponential moving average. Okay, the moment it closes below, that's my exit. Now, if the stochastic, let's say, gave us a lot of signals, I wouldn't look at any signal of these, rather but bullish signals. So for here, I saw a bullish signal, another bullish signal, another bullish signal, another bullish signals. Only I take a trade based on a bullish signal. So if you are, positively averaging, so if you took 0.01 here, that's a trade. another 0.01, another 0.01, another 0.01 lots. This is one way you can trade positive averaging. Basically, every time you see a signal from the stochastic, I can take a trade and aim higher and higher to where, if you look at the 4-hour chart, we said the 1949. So from that area, so until this area, that's my main level. So each time I took a trade, that was my main take profit level. If they hit it, I get out. If they don't, I exit the moment it closes below the exponential moving average. It's very simple. Okay. Now, the last thing that I want to show you is oil prices. Oil prices, it's if we look at it from the latest, sorry, if we look at it from how we just described our strategy here, it closed like yesterday. It closed, sorry, today in the morning at 10 a.m. and it's going for a bullish signal. All right, there is a bullish signal over here. It was confirmed here. Now I would aim. Where is my main level to aim? That level here, 107. So there is $6. Now, when do I get out? At the levels of 97. The moment it closed below it, I get out. So what's my risk over here? From 101 to 97, that's $4 to 6 to 4, almost 1.6 ratio. So it's a really good ratio. Basically, a lot of traders think of it as the golden ratio. So you might take that trade for the short term. So basically, you would wait 3-4 candles, 3-4 hourly candles. If you look at it at the 15-minute chart, that already happened. This could be a FOMO trade for you now. So you might wait for prices to go below this exponential and then return again to the upside. So use it in a smart way. Now, a lot of traders use different strategies. If you have any question about any strategies, please please first of all subscribe to our channel. You will receive a lot of videos, a lot of live action coming in the coming 2 weeks. Also, we have a lot of strategies to share with you guys. There are a lot of market analysts, so please subscribe and like our video today. Thank you so much for tuning in, and see you next time. Thanks again.